G'day everyone, welcome to this global update for the 9th of August, and sentiment really is pretty weak around the world at the moment, and I've been pointing to this and issuing some caution about it now for several months, so this shouldn't come as a surprise to anybody. But I want to provide a bit of a perspective because this is a terrific time to be positioning to make some excellent profits. But you have to position well and you have to retain the right sort of perspective on the market. And there's just so much negative media noise out there at the moment that it's only natural that most people find it extremely difficult to do that. So that's what I want to do in this particular edition. So let's get on with it. I'll just start with a comment from one of the world's greatest ever investors, Peter Lynch. And I think it really does highlight where we're at right now. And he said the key to making money in stocks is not to get scared out of them. And that's certainly happening to a lot of people at the moment. And the media is absolutely cashing in on it. And, it's a great negative news story. And it's just, the wrong time to be, just dumping stocks indiscriminately. So that's really the backdrop to this week's edition. So when we look at American stocks, I just want to provide you an overall perspective here on America. So the S&P was down 1.2% on the week, but the market has been absolutely range bound throughout almost all of 2015, and we've seen 6 months since February where the S&P index has been caught within a 4% range between 2040 and 2135. And with 2 declines to that 2040 level and 4 rallies, which have all failed so far, up to 2135, it's an extraordinarily tight range. I can't recall ever having seen anything like it. We're now in the 2 weakest months of the year traditionally. Doesn't mean that will be the case again this year, but the odds certainly favour that. And that can be very scary for a lot of people when markets get weak like that. Now, the earnings results have certainly been solid enough. There's been nothing overly to be concerned about there. But what I have noticed is because markets are nervous, there's been extraordinarily harsh treatment dished out to stocks that have missed for any minor reason, or even in some cases where everything has been fantastic. There's just been a bit of a negative bias changed to that sector, and everything has been sold off. And one of my favourite stocks came out with the best earnings report that you could possibly imagine, upgraded guidance significantly beyond market expectations, and it's now trading for 20% below its previous peak. I mean, that makes just absolutely no sense at all. Now, just looking at rising interest rates, there's an absolute fixation in the market on when rates will rise and what it means for stocks. And this has been going on for probably nearly 2 years now. But I can tell you that no bull market has ever ended when the Fed started raising interest rates. And here's the evidence as to why. Now, these charts take a little bit of looking at. So you might want to replay this video more than once. But you can see there that the orange line is the Fed funds rate, and the blue line is the S&P 500 index. Now I've got 3 charts. The first one here is 94.95, and you can see interest rates started moving up from 2.5%, got up to 6. Now initially the S&P 500 dipped a little bit, not much, down about 10%, went sideways for about a year, and then started a very, very steep bull market. So interest rates were hardly the cause of stock weakness there. Let's look at the next one, 1998 to 2000. Interest rates started moving up from around 4%, got up to 7%, and throughout that whole period, the S&P 500 index was in a strong uptrend. Now, yes, it was volatile, and yes, there were 3 significant pullbacks, but the trend quite clearly is higher. Let's look at 2005 to 7. And again, the Fed funds rate was increased from 1% to 5%. Look what happened to the stock market. It just never stopped going up. So there is no way that you can say that as many commentators are trying to say at the moment, that because interest rates are going to rise, that the stock market's going to go down. It's untrue. So don't buy into that hype. Now, the second thing we need to look at is the actual stock valuations, because if stocks are overvalued, then previous history may not necessarily repeat itself. And whilst you must be very sector specific focused, if you've been following what I've been writing and publishing over the last year or two, you know that I'm a very individual stock picker, not a general market participant. But the forward PE for the S&P 500 index is only 16. That's around about average. And you compare that to 1987 when the forward PE was 25 times, and the year 2000, which was the last major market top we had based on valuations, and it was 28 that year. So 25 and 28 at two previous big tops, and we're only at 16. So from a valuation perspective, there's really nothing to be concerned about. Now, as far as earnings seasons go, 73% of stocks have beaten on the profit line, and 51% have beaten on the sales line, and that's pretty reasonable. And it's a long, long way better than what we saw in 2000. So there just isn't a basis for a significant pullback in the market, as many commentators are pointing to. So let's take a look at the S&P 500 index initially. So look first of all at the monthly chart. No real change there, and it really just exemplifies over the last 6 months. You can see 6 months here of really, really tight trading. It's really just gone nowhere. Let's look on the daily chart, and you can see pretty mild action last week, and just continues the up down that we've had for quite a long period of time. Just while I'm here, I'll just have a look at the ASX 200 index. Now you can see that we had this quite steep downtrending channel. We got a move above that channel, but still within a consolidation base. And I've been pointing to this for several weeks now as to whether this would be a breakout and the start of a new uptrend in the Australian market, or whether we were just getting a consolidation and it would ultimately turn out to be a false breakout and then a pull back into the range. Well, you can see what's happened Thursday and Friday, thanks to the focus finally getting back to reality on the Australian banks. And the banks were absolutely smashed on Thursday and Friday. And I think with that price action, I think there's absolutely every likelihood that we'll now be back into the channel and back into the downtrend in the Australian market. So be very, very careful in the Australian market, as I've been saying pretty much all year. So just on the Aussie stocks, the Aussie dollar remains in strong downtrend, but as I pointed out last week, it was short-term oversold, and therefore it wasn't surprising to see it move up about 1.5 cents from its lows. But the downtrend remains. And you've got to expect these periods of consolidation. The Australian dollar might just go sideways for a few months in the low 70s. Now, the ASX 200 index was down by 225 points. That's the worst week I can remember in quite some time. And the bank reality finally was recognised. The fact that, it's crazy that banks are trading at their all-time high valuations, and yet all the reasons that have propelled the earnings and the dividends over the last 5 years are now starting to change. So, in my mind, this is not a time to be owning banks unless you bought them a long time ago and you've got heaps and heaps of profit and you're there for the dividend. If that's your situation, then that's a different matter. But if you've bought the banks in recent times, then I think you're on very shaky ground. Now, also in Australia, we've seen more profit downgrades through the week. We saw a big profit downgrade and capital write-off from Orica, and also weakness from Downer EDI. So, this is a reflection of the weakness in the commodity space. So, there's some major problems in the Australian market. Commodities, gold was unchanged for the week. Gold stock indices still sliding gradually, but look, nothing has changed there in that story. Copper slightly lower at 234. The downtrend remains firmly intact, as we'll see from the next chart. And crude oil had a pretty rough week as well, down sharply to 44, and the price action remains very bearish there. There's the copper chart, still in strong downtrend. So really a poor reflection for the global economy. So overall, wrapping up, my strong advice to you is ignore the media noise. If you position well during the next 6 to 8 weeks, then this is when you can make some excellent profits. Most people don't because they get put off by the media. They might have been holding some stocks and the prices pull back and they get a bit concerned and they wonder, will they ever be able to make money out of stocks? But this is a time when you've got to, if you excuse my expression, you just got to suck it up, position yourself well and have the courage to pull the trigger, because this is when you can really make some money. So for those that are interested in communicating with me on what I do and how I might be able to assist you, there's the website address and my contact details. Cheers for this week, and talk to you next week.